Hey everybody, Preston Bryn here with our weekly roundup brought to you by our trader user group. This is for the week ending Sept 7th, 2018. Well, as we come to the end of the first week in September, we're seeing the trade talks continuing with Trump trying to get Canada under control. But we've seen in the market here in the US, consumer confidence is up to the highest levels we've seen since, gosh, going back to 2000. This past week in the jobs numbers, we saw wage growth over 2.9%. That's the best since 2009. Throwing a little bit of an inflation scare into the markets, though. And then China, not to be outdone before the end of the week, Trump threw out a tweet saying that they've got another 200 plus billion ready to go in tariffs with China. So we've got some of those issues coming up as well. As to be expected, the best performer this past week was the utility sector, which is a risk off kind of sector, is up about 94 basis points for the week. And technology really took it in the shorts this week. They were the worst performer for the week, the holiday shortened week. They were down, I think, a little over 3%, 3.1%, 3.14% for the week. So, we've seen the S&P up 5 months in a row. And then the first 4 trading days in September, every day brought us a red day or a red candle. And September's not traditionally been a kind month to the markets anyway, going back a couple of decades. September is usually one of the worst performers. Volatility wise, generally we end the month of September higher vol than when we go into it. And certainly volatility is up. It's been up about 25% over the past week and a half from some of the lows that we saw towards the end of August. So we've got volatility playing its role in September. Obviously, the trading each day hasn't really participated. And we've seen some of the market leaders like technology, Amazon, and a few others really selling off. And of course, Elon Musk continues to outdo himself with craziness, and he's driven the shares of Tesla down pretty good. So I imagine the shareholders and the big funds that are holding shares in Tesla are going to try and do something with Musk, make him chairman emeritus, and possibly bring in someone that really knows what they're doing and running a car company. If they do that, then I think you'll see a big bump in the Tesla stock. Outside of that, it's going to be stopgap measures here is just trying to figure out what it wants to be. So we've seen there's plenty of things on the horizon that can really set this market down lower. As I've talked to our members about probably for the past 2 months now, we've got emerging markets really suffering. Starting over in Turkey and then Argentina. We've seen Brazil with their political issues and the knife attack on one of the right-wing conservative Brazilian politicians. So he's market friendly. So now that leaves a big hole is what they're going to be doing down there. They've got currency issues all across emerging markets. And of course, the stronger the dollar gets, the worse it's going to make these currency issues arising there. And of course, South Africa officially went into a recession. So we've got a number of issues floating around there. And of course, let's not forget Turkey and the bonds over there in Turkey. A lot of people don't realize this. I think I said it last weekend that Turkey is the third largest bond market in the world. And they have just funded a lot of their massive debt with bonds. And of course, it's hidden to some extent because the ECB is buying their bonds, like they're buying other country bonds over there. They're still doing stimulus, but that's due to end in Q4. We've seen equity values here in the U.S. since the lows of March 2009 rise by about 27, $28 trillion. So over 300 and almost 340% since the market lows. And the combined balance sheets of the Fed here in the U.S., the ECB, and Bank of Japan has gone from about 4 trillion to 15 trillion dollars. That's what, 400%? That's insane. And that doesn't include Bank of England with the problems that they've got and some of the hard to grab data from China and what they're doing there. So you just cannot inflate asset prices in the balance sheets like this and then take the money out of the system and not expect another ramification. So we've got some issues coming up. And I've been prepping our members for this for about a year now. And that's not to say it's going to happen next week or even going into the end of 2018. But when the markets start to roll over, it's going to be fun time for those of us that are prepared for it, because there's going to be some great opportunities on the downside for sure. So we've got these issues. And then here in the U.S. too, besides the emerging markets and some of the issues there, close to being in a bear market. China's clearly in a bear market with their index. And what they're doing. But we've got corporations here in the U.S. They've taken on huge loads of debt. They've sold, I think, over 9.2 trillion in bonds to take advantage of the low interest rates, and they've had over 850 billion this year of stock buybacks. It's going to be a record for stock buybacks. So what are they doing with their money? They're doing a lot of stock buybacks. They're taking their shares off, taking float off the market, so it increases their share price. They've done dividends. They've done cash payouts to employees. And then we got the public pension funds, retirement funds that are unfunded to the tune of trillions of dollars. And then we've seen over the past decade this huge shift from active to passive index funds. I've talked about them in prior sessions and what that means when the markets do begin to roll over. That just means there's going to be a smaller door for everybody to try and exit from. And then you throw on top of that all the algos that just tend to fire off at will based on tweet and headline news. So the next bear market's going to be very ugly. There's going to be moves that are probably going to be a number of lock limit moves in the futures market, just because everybody's going to try and exit stage door left at the same time. We're not there yet, but I'm only pointing this out because slowly over the past couple of months, I've been having our members just put a little bit more in cash and just get ready. That's not to say that we don't want to take advantage of more bullish moves. Heck, I'm also on record as saying I think we can make new highs again. In fact, after our all-time highs in January this year and that pullback, I said we're probably going to take that out and make another new set of all-time highs, which we've done. So near term, I think we can expect a little bit of chop, but we're still in a buy the dip mode. Okay. Now looking at the E-mini S&P 500 futures, you can see on the screen here, we had a little bit of a pullback from these highs here, and we're now testing right now the prior all-time highs at 2863.75, and we're just sitting right on that number. We're just north of it by about 9 points or so. Okay. If we break that, then we're probably going to come down and test a little bit lower around the 2800 level, the 50 EMA. Okay, so let's kind of see where we go. The MACD shows no divergences at all. So that suggests all of this is money coming in. It's not necessarily a short squeeze. Okay, so it's money coming in and finding these markets, primarily driven by the strong earnings that we've had. I mean, just had great earnings through these quarters here, and we're expecting strong earnings still in Q3. So that is keeping the markets up. But as I've told our members and our user group, at some point, emerging markets, China and other countries all across Europe and Great Britain could drag down the U.S. markets. Let's just kind of see what happens. If we look at NASDAQ, you'll see NASDAQ broke its trend line. Okay. Right here, you can see this trend line has got a higher slope to it than the S&P, but it broke the trend line, but it held the 50 EMA. If I blow it up just a little bit larger, you'll see here the 50 EMA. NASDAQ came right down to it and bounced hard right up. So the 50 EMA in this shaded zone, here's going to be our support level for NASDAQ. Some of the larger stocks like Amazon, Microsoft, and others, really kind of pull back a little bit on just some profit taking here. And you can see this volume over price. So we've got a lot of support in this area right here. Should this break, NASDAQ's going to move lower. Now, last Sunday, I told our members to look at selling calls out of the money or picking up some shorts in the Qs or NASDAQ here. And that turned out to be, a foretelling move because it really just kind of gave it all up. If we look at the Russell, which is small cap and mid cap, it's also off the all-time highs, but we're holding up the trend line here. Okay, you can see this trend line that really started back in February. We're holding the line. And I wouldn't expect, and the 50 EMA is just after this trend line here. So we've got some support like we do in NASDAQ. So next week is going to be a key tell for us on whether we see another 40 or 50 point move in the S&P, probably another 40 or 30 or 40 point move in the Russell. Same thing with NASDAQ. Okay. It's going to be real important. Now, if we look at the Dow never did make new all-time highs. In fact, we took out the prior pivot highs here. And the only thing holding the Dow down is the trade wars and the conflicts that we're dealing with here. Okay. You can see the 50 EMA. Should it break this prior pivot high right here, then the Dow is going to come down and test the 50 EMA. So that's a little bit about where we're sitting. The Dow is trailing everybody else. And folks, it will not take a lot to have a really bad week and move the Dow back into the red for the year. And if that happens, it's going to really punish the other indexes. So we got to watch that very closely. And if we look over in a global perspective, the Vanguard All World Index, look at the 2018 open price. We're down near the 2018 lows. That is how bad the rest of the planet is shaping up. Now, the 2018 low was made back here on August the 15th, and we were down 14.7%. And as you can see right here, we're just off the lows for 2018, not by a lot. So we're still down around 14%, 13.5%, 14% for the year for the rest of the world. And of course, if we look at China, China is still in a major bear market. Okay, so here's China right here. This is a tracking stock for China, the largest companies in China. And as you can see here, it was down again on the same date, May 5th, or August the 15th, rather. We were down over 32% from the highs. We're in a bear market for China. Of course, the trade tariffs are helping that out, helping them along. But, this at some point is going to start to act as tremendous drag on the U.S. markets as well. You just cannot have the way the global markets are intertwined now, regardless of the protectionism of other countries, including what Trump wants to do here and the right or wrong nature of that policy. You just cannot have the rest of the planet at 2018 lows and the U.S. at 2018 highs. The divergence there is amazing. And we're going to start to feel something. Either the rest of the planet starts to pick up, or we're going to see it start to act as drag on the U.S., regardless of the strength of the U.S. earnings. And then, of course, the Feds here can muck it all up because we got another meeting in the Feds in about 2 weeks. It's about a 95% chance they're going to hike the rates another 25 basis points, take us up to about 2 to 2.25%. Still very low in relative term. And then there's over a 65% chance they're going to hike the rates in December, around December 19th. Another 25 basis points. And then you throw in that wage growth of 2.9%. And then, of course, the markets just assume that's going to be more inflation and put more pressure on the Feds to hike the rates again. And one of the fears, if you remember in one of my earlier weekend updates to you guys, was that one of the fears of some of the biggest funds out there, one of the top 3 fears, is that the Feds is going to create a recession. And in reality, they're not going to create the recession, but they're going to amplify the need for, they're going to amplify the causes that would put the environment conducive to another recession, because they're going to hike the rates too soon. Indeed, this Friday, we saw one of the Fed governors come out and say that they're on track right now to hike the rates, but should inflation start to come back in or start to move back higher again with this wage growth, they may start to take their foot off the accelerator a little bit, but they don't have too far to go. Ideally, the Feds would like to see the interest rates higher so that they got further to pull the rates back off the markets again. So this over engineering stuff is going to get a bit old, and it's just going to cause more chop in the markets, I believe. So this is kind of where we're looking on some of the major indexes. And of course, if we look at volatility, if we look at the VIX, you can see here, I've got the chart coded based on option strategies, based on the location of the VIX. You can see we're up towards the upper end of the green, getting into the lower band of the yellow. Once we get into the yellow, that's when we start to move into a backwardation in the term structure of volatility futures, and then that signals a little bit more fear. We're not in backwardation yet. Okay. The vol futures, for September are sitting around 14.45. The current VIX is 14.88. So we're not in a backwardation term structure right now. We're still in contango. So this week is really going to drive where we go with volatility and where we go with the markets. If the markets can find some consolidation and move up a little bit, you'll see vol come back in again, and you'll see the market settle in just a little bit for a quiet week. Now, if we come over here and we look at treasuries, treasuries has had some wild swings recently. And if we look at bonds on Friday, they really came in. Look at that. That's a big move down. All right. And that came primarily as a result of the jobs wage growth of 2.9%. That means the feds may come down a little bit harder on the accelerator, which means they may raise interest rates, which would drive bonds lower down to this area down here. As I've told you guys over and over again, every time we get in the shaded zone here, you want to be a seller of bonds or picking up puts in TLT. You do not want to be buying. All right. And now we're coming back down here again. So that is a little bit about what I'm seeing in that. And of course, if we look at currencies, well, really, it's just the king dollar and everybody else. If we look at the dollar, again, up strong on Friday with strong wage growth. We've seen the 50 EMA hold up. I am still one of those guys that believes the dollar is not going to get too far up here before it starts to roll over again. All right. I know the Fed's talking with Draghi and all these others. And well, I don't know personally, but I do. They get on the phone and they talk, and they do not want to see these currencies get too far out of whack relative to each other because it's bad for each respective country. Meaning they don't want the euro to get too cheap versus the dollar, or the dollar too expensive versus the euro, or vice versa. And they have a way of talking these currencies up or down without doing anything, because the markets listen to what these knuckleheads say. So we're sitting at a point now where I'm looking for the dollar to run into the resistance up here and pull back just a little bit. And of course, if we look at the euro, it would be just the opposite. I would look for the euro as soon as it comes up on the screen here to find a little bit of support here. You can see the euro came down when the dollar moved up. And then find a little bit of support here and move higher. So that's kind of what I'm looking at near term. Although the emerging markets, if we were to look at emerging markets right now, it's not pretty. If we look at EEM, which is the ETF that kind of tracks emerging markets, and let's just back it out a little bit. That's ugly, folks. I don't know how else to describe it other than just to say that it's ugly. I could put this trend line on it, right? Just like this, and it's probably not going to be straight, but you guys get the idea, right? That's the vector right there. We're down near the 2018 lows, which puts us in a bear market territory. That's where we're sitting right now. That's the emerging markets. You saw China at a bear market, big time bear market. You saw the Vanguard All World Index, which tends to be a little bit more conservative, includes both good and bad. It's still underwater. So again, we've got some larger move risk to the downside across all indexes. And I do believe the US market is a little bit fearful of some of this. And because we don't have earnings right now, all we've got is economic news leading up to the Feds. It's going to be really key as to where we go here near term. I think there's going to be more chop. And we're going to see some more profit taking leading into the Fed meeting coming up in a couple of weeks. Okay. And then, of course, if we look at gold, gold is not a place where money has wanted to go recently. You can see here, and by the way, it's the same with the bonds. We've had a situation where the markets were in the red. We had a red handle every day in the S&P 500, and bonds were down too. And normally you think of bonds as a place for safety, but bonds were down along with the E-mini S&P 500 futures. Now here's gold. Look at gold. Where I believe gold is going to come and take out this 2018 low of 1167 and move down to around the 1100 area, down to about this area down here. That's where I think gold is going to go. Okay. Silver had a rare divergence from gold and actually closed up just a little bit on Friday, but there's clear that silver has just been, it's money's come out of silver big time. Okay. I mean, it's just, there has just been no investing. Look at that. That is a watershed moment right there. And of course, what it was, as I was showing our members on the trade there with silver, you had this kind of setup. like that. I didn't draw it very well, but you guys get the idea. The break, because silver approached the entrance to this asymmetrical or the symmetrical triangle from the top down. So that meant the break was more likely to the bottom. And the measurement of the break is this distance right here, right? And you plug it in and it comes almost down to right in this area right here. So I would expect some consolidation down here. In fact, I picked up some 16 strike puts out in December, right at that level right there of the break. And I've just ridden them down. And now I think we're going to get some consolidation down in this area here. So I may pick up and add to my long position and make a little bit of a bounce back up. Okay, but we're still kind of under pressure in the silver market right now. So I think it could sit like that for just a bit longer. And of course, copper, China is the main buyer of copper, so that you can know what copper's doing. It is ugly, ugly, ugly. I mean, look at this. This is copper futures, industrial metals just getting killed. And I think it's going to go lower if Trump slaps more tariffs on China. This is going to get even worse. But at some point, as you guys know, in the commodity market, extremes, either up or downside extremes, are always great opportunities. Play it down if it's a upside extreme, or play it up if it's a downside extreme. So these are just things that we're watching here that could be really interesting for us. Oil. Well, you know, it's hurricane season now. We got oil coming around. Oil was relatively quiet on Friday, but clearly it's been down. Oil was up over $70 a barrel, and now oil is back down to around 67 a barrel. So it's a $3 move here, sitting in this area right here. I had originally, as you know, when we broke this trend line, I had said oil was going to come down to 63.50. Didn't quite make it, but this could be the formation of an Elliott wave 5, where we got this 3-4-5 pattern right here, a 3-leg, a 4-leg, and then a 5-leg somewhere over in this area here, sometime in late this month, early next month. Seeing oil bottom down here. Now, this would be a seasonal, it would not be unexpected, because seasonally oil traditionally pulls back in September, October timeframe. Gasoline has not been following the seasonal trend. Gasoline has been up. And now this is just a futures rollover, but gasoline has traditionally been very, very choppy. We got hurricane season, and remember, people have a short-term memory, because last year, if you remember, the hurricane through Houston, it shut down all the refineries. So gasoline just shot up like crazy. And now we got hurricanes firing off all over the Atlantic, some coming into the East Coast. Our projected East Coast one looks like it's going to come in maybe into the Gulf way down south, or possibly Mexico, but who knows? So that's going to keep a bid underneath oil and gasoline. I have been trading this as an upside trade. Clearly, this is going upside right here. This is the spread between Brent and WTI. I think I showed you guys last week. It's probably going to come up and challenge this area up here. Why is that? Because Brent is going to be more affected by this November 4th oil embargo than WTI. Because Brent is what the rest of the planet uses. So we're going to see this probably come up into this area before it starts getting rained on and moving lower. I would like to take a trade in this once it gets up here to the downside, like we did over here. But that's where I see this spread moving right now. And that'd just be a little bit of a move there. But I do see that happening. And again, even if you're trading the spread, it's $1,000 a point. Okay. Corn, wheat, soybeans in the ag market. Well, Al, you guys know we got out of our soybean trade. We made profits as we rode it up. It's come back down here again. I had projected soybeans to actually make a new 2018 low. We haven't made it yet. We're fumbling around down here. If we can break out to the upside, I'll trade this to the upside. You can see it's hovering. Every time it hits the 50 EMA, sellers are coming in and pushing it lower. As it starts to chop around here, I think being long soybeans could be a higher probability trade. Okay. And if we look at wheat's been one of the stronger ones in the ag market. You can see wheat is well over. I mean, we've moved up, but it's it's doing fairly well. I mean, it's hanging in there fairly well. So this is where we're sitting right now, folks. I hope you guys have a great weekend. For those of you that are not members of our group, I highly encourage you to come in. We got a lot of really interesting setups coming in Q4 of this year. And next year, we're going to be doing some things that we're going to be setting up for a bear market that'll probably be hitting in the next year, year and a half, or at least that's the way the charts seem to indicate. We're not going to hit the peak. We're not going to hit the valley, but we want to be in the middle of it like we were in '08 and '09, and then in 10 and 11 when the markets were bouncing hard back up. So hope to see you guys in. Members, I will see you tomorrow night for our weekly market watch. Have a great weekend, everybody, and I will see our members tomorrow night. Take care, folks. Ciao.